My name is Calum Ross. I'm a mortgage originator or mortgage broker in the city of Toronto. I specialize in mortgage financing for real estate investors and higher income professionals. Really what we try to do that differentiates us from other people is we try to integrate the mortgage into the short and long term financial goals. So what we try to do is take a look at the client's overall cash flow payment, tax and equity objectives, and then try to balance it into the longer term financial plan. It's interesting you bring it up. You'd say that a mortgage professional should do that. I mean, one of the challenges is that the barrier to entry in the mortgage industry is unfortunately not high enough. And so what we have is across Canada, the number of hours required for someone to be a mortgage professional is actually only about 40 hours. And then within the banks, they've got a lot of training. You can actually be a mortgage officer in sometimes less than a day's training. And so while someone should keep on top of the knowledge, the truth is they really don't. What I find in my world is that despite both my undergrad and MBA being in finance, there's an awful lot of information available. And I think it's not about the information, it's about deciphering the good information versus the bad information. And so what I would suggest is that there's a lot of fear and panic in a lot of cases in the real estate market. And this seems to happen all the time as a change. But what we find happening more often than not is that the media is sensationalizing a small number of facts that are not material. And the end user, unfortunately, doesn't understand the information it's given. So as a result, they have a tendency to interpret the data the wrong way. When we look at things in a real terms, without sensationalizing the highs and the lows in the market, what we're looking at is still a very affordable housing market, a near lifetime low in interest rates, and quite frankly, people buy payments, they don't buy actual prices and they don't buy interest rates. And in real terms, we still have, in a global universe of available cities, a very affordable housing market here in Toronto. Well, the mortgage rates is a much more complicated issue than people think. First of all, one of the challenges we have in Canada, and particularly in Toronto, is there's a massive difference between quoted rates and real rates. It's really, really interesting that you have people all the time quoting these mortgage rates that essentially have mortgage products that are going to put consumers at risk. They're not refinanceable, they can't be ported to a new property, they've got prepayment restrictions that don't make sense. What we know is that first-time buyers on average stay in a home between 3 and 5 years. And yet what we also know is that most first-time buyers go with a 5-year fixed mortgage. If that seems fundamentally unjust to you, that's because it is. It's amazing to me that mortgage professionals all the time run around the city quoting 5-year mortgage rates when in fact most first-time buyers are going to be breaking that mortgage. And so the key thing that consumers need to look at is understanding their hold cycle, understanding what their real cash flow is, understanding what the real features that they need in a mortgage, because I would liken a lot of prepayment privileges and a lot of features to a mortgage as having a convertible in northern Canada. It's a really cool feature to have, but it's not that practical. And so when consumers, and particularly first-time buyers, are looking to get a mortgage, they need to be mindful of the fact that making sure they have a fundamental understanding of the basics is really, really important. There's a old saying that I've heard over and over again. It's to the fool, every option is good. And I would suggest that we have a lot of very, very polished people here in Toronto that unfortunately get mortgage wisdom and input from people who are not qualified to give it. And while it's very interesting to have someone offer me interest rates advice or real estate advice, factually, if they're not qualified to give it, it's really not worth anything. And I find over and over again, you find people deferring to their parents, friends, and other people who are often willing to give very useful mortgage advice in their opinion, but in factual terms, they actually don't know what they're talking about. In today's market, the mortgages that we have today are very different than the mortgage products we had in our parents' day and age. The truth is that it's not just about the rate, it's about the payment, it's about the features. And it's great to be able to save 0.1% on a mortgage product, but when that 0.1% will only save you a couple $100 a year and the penalty to get out of it is thousands of dollars, you obviously haven't done yourself a service. Mortgage insurance is actually, like you say, it's a bit of a misnomer because over and over again people think they're getting insurance, and what that insurance is doing is it's insuring against the default risk. But the default risk is not the default risk against the consumer. In this case, it's the default risk against the borrower. In Canada, even though we have a lot of non-bank lenders, in many cases those bank mortgage loans, those loans are in fact sold to the big banks. And what that insurance is doing is it's insuring the lender against the risk of default. Specifically what it does is it covers the risk under the National Housing Authority Act, and it looks at the idea of people borrowing with less than 20% equity in the property. And when that happens, what it's doing is it's insuring the bank against the default risk, providing the actual borrower meets the insurer guidelines. And an important distinction that consumers need to realize is that while they are paying the insurance premium, in many cases, because that mortgage loan is insured, it gives them a lot of other options in terms of mortgage lenders. The secondary thing that it does is in many cases it actually can give the person a lower rate. In Canada, the Canada Mortgage Bond Program and the high ratio mortgage insurance bonds actually enable someone to get a lower cost of funds sometimes. So even though to the consumer they think I'm getting a high ratio mortgage, it seems like there's a greater risk. Because of the insurance premium that's being paid on that loan, in many cases it gives the lender or the bank the ability to lend out the mortgage at a lower rate for the consumer. When consumers are out there looking for a mortgage, one of the common challenges that we find is that they make decisions on items that actually don't matter. So, over and over again, the only thing that a longer-term mortgage product truly gives over a shorter-term mortgage product is peace of mind against the interest rate or the contract going up. And when you look at a variable rate mortgage in Canada is typically priced off the overnight lending rate by the Bank of Canada, which could move at any given 9 announcement dates that the Bank of Canada has. In the case of a fixed mortgage is tied to a specific point in time, so a 6-month term, a 1-year term, up into a 10-year term in practical terms. But the only thing that longer-term mortgage product is truly doing is insuring you against interest rate risk. And like any type of insurance that an individual makes, if you are insuring yourself and paying too much for a risk that you don't deem to be worthwhile, you essentially are paying too much for that premium. And so what I find is that over and over again, people get so caught up in the idea of having the peace of mind, they actually don't stop to think about what that peace of mind is costing them. And so when you look in real terms, if the difference on a mortgage product, an interest rate, even between a 10-year and a 1-year is 1% on $100,000. In consumer language, they think that this interest rate is actually a big difference. In real terms, what it costs is $1,000 a year, so less than $100 a month. And yet, what that consumer is getting in that case is peace of mind against 9 years of interest rate risk. Now, obviously, different people have different perspectives in terms of how they value that risk, but what we do know is that when a consumer stops to actually think through what they're getting in terms of benefit and they look at what in terms of costing them, they're able to make a much more informed decision. Yet over and over again, what we have is consumers jumping on the bandwagon because of a price discount or because of the way that mortgage providers and banks are selling products that are profitable for them as opposed to in the best interest of consumers. The first thing that I would say a first-time buyer should put on their checklist is interviewing their mortgage professional. Again, the barrier to entry is so low, and the difference between the very top people in the city versus the people who are barely making ends meet is a big deal. And the other thing too is that when you consider the fact that the average mortgage person in Toronto does less than $7 million worth of business, and you consider the top people are doing $150 million worth of business, in any given year they've got 20 times more experience, which makes a difference. I'm not saying that they necessarily are better, but if I was going to use a surgeon, I'd definitely want the one with 20 times more experience. The second thing that consumers need to do is make sure they get their paperwork in order. Over and over again, I find banks and mortgage professionals are so fixated on giving consumers approvals, they actually haven't taken the time to go through the right paperwork. And yet, over and over again, I find clients coming to my office who tell me they've been pre-qualified by a bank or another mortgage person, when in fact that person has actually never properly checked their credit, made sure their income documents are in order, and made sure that actually fits the overall budget. And the final piece that people need to do when they're looking at getting a mortgage is be very realistic about your cash flow. The truth is, when you're buying a place for the first time, there's a lot of closing costs that come up. It's very expensive to decorate a place and to actually move in and make the place livable. And what I would point out is that you're way better to err on the side of caution and buy below your qualifying amount and be conservative in your purchase price. There's nothing worse than when I see my clients being house rich and cash poor based on the idea of trying to buy something on an expanding lifestyle. It's very, very important that you're cautious and that you make a mortgage decision and a financial decision that is consistent with what your budget and your income growth goals are. I think the redpin.com is an amazing source of housing information. I can tell you that I have 8 years of post-secondary education. I read publications from really around the world to build my economic and financial knowledge. And I will say that the redpin.com has got to be one of the best sources of housing information and easy to understand consumer information that helps people make informed decisions. And that's a very, very important part of the real estate buying process.